All right, imagine this for a second. You're running a business, right? Could be anything, restaurant, maybe a factory, even a doctor's office down the street. You need stuff. Uniforms for the team, floor mats so nobody slips. Got to keep the restrooms stocked. Maybe get those fire extinguishers checked, the essentials. So who do you call? Well, for over 1 million businesses here in North America, there's a good chance it's one particular company.
That's right. And today, we're going DAP on that company, Cintas. They provide all those absolutely crucial outsourced services that businesses need to just operate day to day. Things you might not think about, but they're essential.
Yeah, exactly. So our mission for this deep dive is really to pull out the key insights from this pretty detailed business analysis we've got. We want to unpack Cintas' staying power, figure out its competitive edge, and also, honestly, dig into some of the complexities that aren't obvious at first glance. It seems simple, but maybe it's not. We'll look at why people call it a wonderful company, but importantly, why its current price tag, its valuation, might make you pause and think.
Okay, so let's start right at the core. Cintas' business model, what are they actually doing? Fundamentally, they provide these outsourced services that businesses kind of have to have. Non-discretionary stuff. Uniform rentals are the big one, but also facility services, think floor mats, mops, restroom supplies, plus first aid, fire protection.
And the key thing is, it's not just selling a product once.
No, exactly. It's contractual, it's recurring revenue. Businesses sign multi-year deals, and Cintas just keeps showing up week after week delivering those services. That predictability is huge.
And looking at the numbers, that uniform rental and facility services piece, that's 77% of their revenue recently? It's the lion's share.
It is. But what's really smart is how they build on that initial uniform relationship. That's where the cross-selling strategy comes in.
Okay. So once the truck's already going there.
Precisely. Once that Cintas truck is pulling up to deliver uniforms anyway, the extra cost to, say, restock the first aid kit or check the fire extinguishers, it's minimal. It's incredibly efficient.
And that does more than just add revenue, right? It makes the customer harder to lose.
Definitely. It makes them much stickier, as they say.
Yeah.
Because now you're not just getting uniforms from them, you're getting maybe 3 or 4 essential services. Unwinding all that to switch providers becomes a real hassle.
A hassle that probably keeps customers around, which has got to be good for profits.
Oh, absolutely. The profits are driven by really healthy gross margins. We're talking around 50% for the core uniform business. And this concept of operational leverage from route density.
Route density. Okay, break that down. What does that mean in practice?
It just means having a lot of customers clustered closely together on a single delivery route. The more stops they can make in a short distance, the lower their cost per stop. Think driver wages, fuel, it all gets spread thinner. More density equals more efficiency.
Okay, so it sounds, almost too simple on the surface, but clearly it's working incredibly well.
It is intelligible, right? The core idea is simple. Cintas solves basic business problems. Looking professional, keeping things clean, staying compliant with safety rules. Get this, the company actually started way back during the Great Depression.
No kidding. What did they do then?
They collected dirty factory rags, cleaned them, and sold them back. Doesn't get much more fundamental than that.
Wow. From cleaning rags in the Depression to this massive operation today, that really tells you something about how basic and enduring these needs are. So what keeps this model going strong decade after decade?
We've got a few things. Just basic human behavior. Businesses always want to look good, keep things tidy. Then there are bigger trends, like companies increasingly outsourcing jobs that aren't their main focus. Why manage uniforms yourself if someone else can do it efficiently?
Right, focus on what you're good at.
Exactly. And then there's the regulatory angle. Things like fire safety, certain types of workwear, they're often required by law. It's not optional.
Which brings us back to that toll road idea you mentioned.
Yeah, that's a good analogy. Cintas is kind of like a toll road for businesses. You need their services to operate smoothly day in, day out, and it makes their revenue incredibly resilient, even when the economy gets shaky.
Okay, so resilience, recurring revenue. That sounds great. But competitors exist. What stops them? This is where the moat comes in, right? Cintas seems to have a fortress. What's the main defense?
The primary moat, the really big one, is a scale-based cost advantage that comes directly from that route density we talked about. Cintas is just enormous compared to everyone else. They have something like over 11,700 delivery routes, hundreds of processing plants across North America. The scale is just vast.
11,000 routes. That's hard to even picture. How does just being big translate into lower costs?
Think about a Cintas truck versus a truck from a smaller local competitor. The Cintas truck likely travels much shorter distances between each customer stop because they have so many customers packed together. Less driving time, less fuel burn per customer.
Ah, okay. So their biggest variable costs, driver time and fuel, are just structurally lower.
Exactly. And that gives them huge power. They can either charge less than competitors to win business and still make good money, or you can charge the same and just enjoy much better profit margins. It's a massive structural advantage built over decades.
So that density moat is powerful. Is there anything else protecting them? A secondary moat?
Yeah, the switching costs are high, partly because of that lower cost structure allowing bundles,
Yeah.
but also just the inherent friction. If you're getting uniforms, mats, first aid, all from Cintas, imagine the logistical nightmare of coordinating 3 or 4 new vendors to replace them.
Right. The hassle factor.
Definitely. And then you layer on the contracts. Standard deals are often 3, maybe 5 years long. And critically, they usually have automatic renewal clauses baked in. So if you're not paying close attention, you're locked in for another term before you even realize it.
Okay, let's make this concrete. Say I'm a gutsy entrepreneur and I want to start a uniform rental company in, I don't know, Phoenix, where Cintas is big. What happens?
You're facing an uphill battle from day one. First, you need massive upfront capital investment buildings, washing machines, trucks, inventory. Then, even if you get customers, you won't have the density Cintas has. Your cost per customer will be way higher.
So Cintas can just undercut my prices.
Easily. Or they can offer existing customers in Phoenix an even better bundled deal to keep them loyal. They can use their scale and profitability in other markets to subsidize a price war in Phoenix if they need to. It's incredibly hard for a new entrant to gain traction against that kind of entrenched advantage.
It sounds like this fortress isn't just standing still either. The analysis suggests the moat is actually getting wider. How are they managing that?
Well, look at their market share. In the U.S. uniform rental market, they might have, some estimates say, over 50%. Dominant. But here's the kicker. They estimate there are about 16 million potential business customers in North America, and they currently serve only about 1 million.
Wait, only 1 million out of 16, so the market is still mostly untapped.
Exactly. Most businesses are still what Cintas calls non-programmers. They handle this stuff in-house, maybe buy their own uniforms, have staff clean the mats. Cintas sees this huge pool of businesses as their main growth opportunity.
That's a massive runway. So how are they going after that 15 million?
Acquisitions are key. They made that huge $2.2 billion deal for G&K Services back in 2017, which really bulked up their scale and density. But they're constantly doing smaller tuck-in deals too, buying up smaller local or regional players like Paris Uniform Services or Cytex.
And each acquisition makes their routes even denser.
Precisely. It adds customers to existing routes, lowering costs further, strengthening that moat. And they're good at keeping the customers they buy. Those retention rates are really high, like 97% for their core stuff. That's proof the lock-in works.
Any other ways they're widening the gap?
Technology investment is a big one. They've poured money into things like SAP for managing the business and Smart Truck software to optimize routes even further. It just makes their operations slicker and harder for smaller competitors to match.
So it's like this flywheel effect, right? Growth leads to scale. Scale means density. Density lowers costs. Higher profits generate cash, which they reinvest in tech, and more acquisitions, which fuels more growth.
You nailed it. It's a self-reinforcing cycle. And remember that stat. 60% of their new business comes from those non-programmers. They're not just stealing share, they're actively convincing businesses to start outsourcing in the first place. They're growing the whole pie.
Okay, this sounds like an incredible business machine on paper. Almost too good to be true. This is where we need to talk about the scuttlebutt, right? The word on the street, what customers and employees really think. Because there seems to be a bit of a disconnect here.
There really is a fascinating paradox. You look at those retention numbers, 90% plus, and you think, wow, customers must love them. But then you dig into the qualitative stuff, the actual reviews and complaints, and it's quite different.
How different are we talking?
Well, take the Better Business Bureau rating for their corporate HQ. It's 1.45 out of 5 stars based on over 140 reviews. And they've had nearly 250 complaints filed there in just the last 3 years. That doesn't exactly scream customer delight.
Wow, 1.15 stars. What are people complaining about specifically?
A lot of it centers on those contracts we mentioned. People feel trapped by the 5-year terms and the auto-renewal clauses, finding them really hard and expensive to break. Aggressive tactics are mentioned quite a bit.
And billing issues, too, I imagine. That seems common with recurring services.
Yep, that's a big one. Complaints about being charged for services they didn't receive, or for lost items they swear they returned. Unexpected price hikes during the contract term are another frequent frustration. And then there's the service itself reports of dirty or damaged uniforms, sizing issues, slow response times.
So, okay, putting this together, the high retention isn't necessarily love. It's more like the moat is working too well. The cost and pain of switching are so high that customers just grit their teeth and stay, even if they're unhappy.
That seems to be a very plausible interpretation. The switching costs, driven by the contracts and the hassle factor, outweigh the dissatisfaction for many customers. It's retention by captivity, perhaps, more than satisfaction.
And does this sort of tension show up inside the company, too, between the corporate image and maybe the frontline reality?
It appears so. Cintas regularly gets recognized on lists like Greatest Workplaces. They talk a lot about their positive, partner-focused culture, developing people from within. I mean, the CEO, Todd Schneider, he started in their management trainee program way back in '89.
That's the official story. What about the people actually driving the trucks, the SSR's service sales representatives?
Well, feedback from folks in those roles often describes a really high-pressure sales environment, a relentless focus on hitting growth targets, revenue numbers, upselling existing customers.
Ah, the upselling. And their pay is tied to that.
Yeah, commissions for upselling are part of the compensation structure, and the general managers running the local depots. Their incentives are often heavily weighted towards the profitability of their specific location.
So you can see how that might create pressure, right? Pressure to push sales, maybe cut corners on service, or be aggressive with contracts and billing, all to hit those numbers. Could that be driving some of the customer friction?
It's a very real possibility. It points to a potential misalignment where the drive for short-term financial results at the local level could be creating this simmering customer dissatisfaction and ultimately a latent reputational risk for the whole company. It's definitely a tension worth noting.
Okay, we've looked at the business mechanics, the moat, the customer experience. Let's shift focus to the people at the top, the leadership. You mentioned the CEO, Todd Schneider, is a Cintas lifer.
Yeah, started right out of college in their management trainee program in 1989. He's worked his way up through seemingly every part of the business, knows it inside out.
And what's his guiding philosophy? How does he think about growing Cintas?
It seems very consistent, very focused. 3 main pillars. 1, keep expanding the total market by converting those non-programmers who do things in-house. 2, gain market share from competitors, often through acquisitions. And 3, sell more stuff to the customers they already have, that cross-selling piece.
A clear playbook. How have they done putting that playbook into action, particularly with how they allocate capital, how they spend their money?
They seem quite disciplined. They reinvest consistently back into the business, organic growth, technology. CapEx was over $400 million in fiscal 24, and acquisitions, as we said, are central. Everything from small local tuck-ins to that massive G&K deal.
And what about shareholders? Do they see a return?
Oh, yeah. Cintas is what they call a dividend aristocrat. They've raised their dividend payment to shareholders every single year since they went public back in 1983. That's remarkable consistency. And the increases are often substantial, mid to high teens annually.
Wow. And share buybacks, too.
Aggressively. They bought back $1 billion worth of their own stock in fiscal 24 alone. So they're returning a lot of cash to shareholders through both dividends and reducing the share count.
Is there any sign they get caught up in, like, empire building, making deals just to get bigger, even if it's not the best use of capital?
There's actually a good counterexample. A while back, they were in talks to buy one of their main competitors, UniFirst. They made an offer. UniFirst wasn't interested at that price, and Cintas just walked away. They didn't get into a hostile, potentially value-destroying bidding war. That suggests discipline over ego.
Okay, solid management, disciplined capital allocation. Now let's look at the financial results themselves. Is the term financial fortress justified here?
Qualitatively, absolutely. The consistency is just stunning. They've grown sales and adjusted earnings per share in 51 out of the last 53 years. Think about that through multiple recessions, booms, busts.
51 out of 53. That's incredible resilience, even through COVID.
Yep. Stayed profitable right through fiscal 2020. And their profitability is actually improving over time. Gross margins are pushing 50%. Operating margins are climbing past 22%. It's an earnings machine.
Those are strong trends. What about the key ratios that tell you about the underlying quality and efficiency, like return on invested capital?
That's where Cintas really shines. Their ROIC is consistently in the, let's say, 27% to 30% range lately. That is truly elite territory.
Mm.
It means for every dollar they invest back into the business, they're generating a very high return, significantly above their cost of capital, which is estimated around 9.7%. They are creating substantial economic value.
And that ROIC has been going up over time.
Yes, significantly. If you look back about a decade, say fiscal 2015, it was maybe around 14%. Now it's consistently over 25%. That's a fantastic trend.
Okay, high returns on capital. What about cash flow? Are the profits turning into actual cash?
Absolutely. Their free cash flow conversion is excellent. In fiscal 24, they generated about $1.67 billion in free cash flow from $1.57 billion in net income. That's over 100% conversion, meaning the cash generation is even stronger than the accounting profit suggests. Very high quality earnings.
In the balance sheet, does it live up to the fortress name?
It really does. They have very little debt relative to their earnings. Their net debt to EBITDA ratio was about 0.8 times in fiscal 24. That's incredibly low leverage. Gives them a huge safety buffer and tons of flexibility to make acquisitions or weather downturns without financial stress.
Okay, so let's recap. We have what looks like a truly wonderful company. Dominant market position, a wide and widening moat, exceptional financial performance, great management. But there's always a but, isn't there? What about the price you have to pay for all this quality right now?
Yeah, that's the crux of the issue for potential investors today. Around July 2025, the valuation is, well, it's steep. The price to earnings ratio, the PE, is hovering around 50 or 51. The price to free cash flow is also quite high, maybe 49 times based on the last year's numbers.
50 times earnings. How does that stack up historically for Cintas? Are people usually willing to pay that much?
No, this is definitely on the high end, even for them. Its current PE is more than 30% above its average over the last 5 years, which was closer to 39 times. So the market's pricing in a lot of continued success and growth, a premium on top of a premium.
So the takeaway is, fantastic company, no doubt, but the current stock price looks like a demanding entry point, as the analysis puts it. Not much room for error.
Exactly. You're paying a price that already assumes things continue to go really, really well. There's potentially very little margin of safety if anything unexpected happens or if growth slows down even slightly.
So if the valuation is demanding, where does the market expect all that future growth to come from? What's the engine?
The main engine is still converting that massive non-vended or non-programmer market. Remember those 15 million businesses still doing things in-house? Cintas says 60% of its new business comes from convincing those companies to finally outsource.
Right. With only 1 million served out of 16 million potential customers. That's years, probably decades, of growth potential just from converting the existing market. It's a huge runway.
It really is.
Yeah.
And that's supplemented by cross-selling more services to their existing 1 million customers, where penetration rates for ancillary services are generally still quite low, often below 20%. So 2 big levers for growth.
Okay, but even with that runway, no business is risk-free. What are the big long-term threats that could permanently damage this picture? The potential impairment risks.
Well, the biggest potential structural threat is probably a fundamental shift in how and where people work. If remote work becomes even more widespread and permanent, or if automation significantly reduces the number of employees needing uniforms in certain industries, that could shrink Cintas' total addressable market over time.
Makes sense. Fewer people in physical workplaces means less need for uniforms, mats, maybe even restroom supplies at the same scale. What about those customer service issues we talked about? Could that boil over?
It's a definite latent risk. All that dissatisfaction simmering under the surface around contracts and billing. Imagine a major class action lawsuit gaining traction, or really negative media attention focusing on those practices, or perhaps new regulations targeting long, auto-renewing service contracts. Any of those could seriously damage their brand and force changes to their very profitable but sometimes controversial business model.
And any technological threats, like what if someone invents uniforms that never get dirty?
Well, maybe not self-cleaning uniforms tomorrow, but yeah, breakthroughs in fabric technology are a possibility. Imagine hyper-durable materials that last much longer, or smart fabrics with embedded sensors reducing the need for certain services. It could, over the very long term, lessen the need for the frequent laundering and replacement cycle that's core to their rental model. It's more distant, but a potential disruption.
All right, let's try some second-level thinking. Beyond just the surface facts, what's the general market consensus on Cintas? What does Wall Street mostly think?
The consensus view pretty much nails the basics. Cintas is seen as a top-tier industrial services company, a reliable compounder, wide moat, great management, strong financials. No one really disputes the quality.
Yeah.
But the consensus generally concludes that all that quality is already fully reflected in the high stock price.
Yeah.
Maybe even more than reflected. So the typical analyst rating is often something like hold or sector perform, basically saying, great company, but too expensive to buy right now.
Okay, so that's the standard view. Our deep dive, though, suggests there might be more to the story, factors the market is maybe underappreciating, a contrarian angle.
That's the idea.
Yeah.
This analysis argues the market might be missing, or at least underestimating, three key long-term points. First is the true scale of that untapped market.
The 15 million non-programmers.
Right. The market might see Cintas as maturing because it dominates the current outsourced market. But the contrarian view is that Cintas is still in the early innings of creating a much larger market by converting those in-house businesses. The growth runway is potentially much, much longer than for a typical industrial company just fighting for existing market share.
So the market size itself is misunderstood. What's the second point?
The dynamic nature of the moat. The market might see the moat as static, but it's constantly getting stronger. Every acquisition, every tech investment funded by their strong cash flow widens that moat, lowers their costs, makes outsourcing even more attractive to potential customers, which then accelerates the conversion of that untapped market. It's a reinforcing loop.
A compounding moat, essentially. And the third factor?
It's appreciating the sheer power of compounding capital at such high rates of return. That 25% plus ROIC is incredibly potent over long periods. Focusing just on today's PE ratio might miss the forest for the trees. The argument is that the relentless value creation from reinvesting cash flow at such high returns, decade after decade, could justify what looks like a high price today if you have a truly long-term perspective.
Okay, so summing up that second-level perspective, the market sees a snapshot, a high-quality but expensive company. This deeper analysis suggests looking at it like a long movie, a dominant force actively expanding its own market and compounding value at an elite rate for potentially decades to come.
That's a good way to put it.
All right, let's bring it together. Quick summary of the investment thesis. The bull case, why would you own Cintas, even at this price?
You own it for that dominant, widening moat built on rote density, for the enormous multi-decade growth runway converting non-programmers, for the truly exceptional financial quality, the high ROIC, the strong cash flow, the fortress balance sheet, and for the proven, disciplined management team allocating capital wisely.
Okay, now the bear case, the counter-argument. Why might you avoid Cintas, or be cautious?
The primary bear case is that demanding valuation. 50 times earnings leaves very little room for error. Then there's the latent reputational risk simmering from all those customer complaints about contracts and billing. You also have potential long-term headwinds, like a major shift to remote work, shrinking the market. And finally, that possible internal incentive misalignment driving behaviors that hurt the customer experience.
Now for the final challenge, the red team exercise. Let's actively try to break the bull case. If we invert the argument, what's the core vulnerability?
The core vulnerability, if you really push on it, is that the moat relies heavily on customer captivity, achieved through those sticky contracts and high switching costs, rather than genuine customer preference or delight. And a moat built on captivity can be more brittle than one built on love.
Okay, so if captivity is the weak point, how could a competitor exploit that? Paint a picture of the anti-Cintas.
Imagine a smart, well-funded disruptor, maybe backed by venture capital, or even an offshoot of a logistics giant like Amazon or someone similar. They don't try to beat Cintas on density overnight. That's too hard.
So what do they do instead?
They attack the vulnerability. They build their entire brand around being the anti-Cintas. Radical transparency, simplicity, customer friendliness. Think simple, easy to understand one-year contracts, or even month-to-month options. No sneaky auto-renewals.
And how would they manage service?
A slick, modern, digital platform. Easy online ordering, clear billing, responsive customer service.
And here's the killer move. They'd actively use Cintas' poor BBB ratings and negative online reviews in their marketing. Their pitch would be, tired of being trapped, we'll liberate you.
Wow. Weaponizing Cintas' own customer dissatisfaction against them. What kind of damage could that do?
Even if they only peel off a small percentage of customers initially, it could have a huge impact. It would force Cintas to respond, likely by making their own contracts less restrictive and more customer-friendly. That immediately hits profitability. So higher churn, less pricing power.
Exactly. It could lead to permanent margin compression, as they have to compete more on service and transparent pricing, not just lock-in. Long-term growth would slow down, and the market perception would shift.
How would the market react?
Cintas might get re-rated. Instead of trading like a premium high-growth compounder at 50 times earnings, maybe it starts trading like a more standard, mature industrial services company at, say, 25 or 30 times earnings. That multiple compression would mean a significant hit to the stock price, potentially a large loss for investors who bought in the peak valuation. The mistake in that scenario would be underestimating how vulnerable a moat built on lock-in can be to a truly customer-centric innovator.
Okay, that's a compelling red team challenge. It really makes you think. So that brings us to our final thought for you, our listener. If Cintas' incredible success is so tied to locking customers in with contracts and making it painful to leave, what innovative approach beyond just competing on price do you think a new competitor could use to genuinely disrupt this industry and win customers based on something other than captivity, something to ponder?